If you're trying to get insurance on your stock position by buying puts, it's a great way to defend and protect it. The problem is it costs money. Money's coming out of your pocket to purchasing the put. So how do we actually do this in a smart way to where we can get the insurance, have the insurance, but not have it cost anything? In fact, we can even maybe make money behind it by still having our insurance, but not paying a dime out of our pocket. So how do we finance this concept? If you don't know me, I'm Sasha, the options coach, and I've been teaching people to trade options over the last decade. I even have some books on the subject as well. But the thing that we want to talk about today is how do we get puts and get insurance on our position without spending too much money? So that's what I'm going to share with you today. Now, this is a concept that we've talked about in one of my latest classes. It's called the zero cost put buying strategy. It's not really anything magical or secret or magnificent. It's really just understanding how the options market works. Because when you go in and you're looking to purchase a put, what it really does is it allows you to reduce the downside risk. So let's say I buy a stock here and I'm looking for the stock to appreciate. Well, also, if the stock continues to go down, I keep losing money up to a certain point where if I do purchase a put, so here's my buy put spot right here in this corner. If I buy that put, it limits my downside losses. The problem is that when you buy something just like car insurance, it costs me money. So let's just say it cost me $200 for this month, then another $200, and then another $200. And over time, you might say, well, the car insurance or the value of that put is just not worth it. It's not really beneficial to me because I keep losing money. And over time, that amount could be $1,000, $2,000, $5,000, depending on the amount of shares you're trying to insure, and also depending on the cost of the options market on that put that you're looking to buy. So the thing is that over time, you constantly keep losing money from this insurance. Now, I'm not saying that buying insurance is a bad thing, because in a lot of cases, it is wise to have insurance, especially when you're dealing with, let's say, $50,000 position. You might say it's wise to insure that position because people with $50,000 car, even with a $10,000 car, have insurance. But here, when you're dealing with $50,000 of stock, people don't always get insurance. Even with $300,000 portfolio, they might not have insurance. So what you can do is buy the put. So it is a smart approach. But now, how do we actually do it a bit cheaper? And this is kind of what we covered in the zero cost put buying strategy. So if you have some questions about that, feel free to reach out. Let me know in the comments, and I'll be happy to send you some more details and information about a lot of the different classes here that we do. But within this concept, what I want to show you is that if you go in and actually look at what you're getting here, when you buy a put, you still get the unlimited upside on the stock. So the upside is unlimited. The downside now is limited. It's capped. There is a max loss that you have, which is really nice because if the stock goes to zero, you can put that stock to someone else. But what you could do is go in and give up part of that upside in order to pay off and finance the put over here. So in other words, let's say the put that you purchase, it's just a simple buy and sell concept. So if we're looking to purchase a put, and when we buy something, we actually lose money. So that's why I'm going to make it in red. So when we buy something, we're losing, let's say $200, and then another $200, and then another $200 because we're purchasing. But what if we sell something and we get money back as a business owner, and we can get back about, let's say, $150 and another $150 and another $150? What this does is, yes, we take a hit of $50 on each position. Okay, so we are losing $150 in total from this, but it's not the $600 loss that we would have had if we just bought the puts individually. And what we could do actually is when we sell calls against this, which is financing this put, what we could do is actually, instead of selling something for $150, we might actually be able to sell it for, let's say, $210. So now we're actually gaining $10 on everything that we sell. But the downside is, of course, we're willing to give up some of the upside. So I want to show you how this works here. Here I've got Intel, and Intel right now in this position, I'm down about $500. So let's say I'm looking to insure that position, saying, hey, I don't want it to keep going down too much further, but I'm willing to insure it at this price of $21. Now, the current stock price is at 24, but I want to insure it at 21. So if I buy these puts, it's going to cost me 62 cents a piece, and I've got 300 shares. So let's say I get 3 of them, okay? 3 times 62, so 6 times 3 is 180. It's going to cost me about 180 bucks, 186 as you can see. So I will go in and send that off, and now we are filled. And what that does is limit my downside. Okay. The problem here is that if this thing stands still, you can look by the risk profile picture, I'm losing $186. Well, what I can do instead now is, look, I've spent $62 a piece on these. I can go to the call side and sell these for 86 cents a piece, and I can sell 3 of them. Well, 3 times 86 is a lot better than 3 times 62 because I'm selling these and collecting premium. And at the end of it, I'm almost making about, well, you know, the difference here between each one is, 60, 70, 80, about 25, $6 a pop. And when you go to 3 of them right here, you're making back actually $75. So you're, in theory, putting on a put or placing a put, and then you're selling some calls against it, and you're getting $78 back in value. Now, this does limit the upside a little bit, so you have to be comfortable with that. But overall, now that put that I've got, I'm still able to, hey, use the put or have the put. But now my max loss here is 1422 because that is kind of where the put is. I'm able to put the stock. So it's the stock loss, 1422. But if I didn't have it, my loss would be 1686. So that means I would have to realize the full loss of those puts. But by selling those calls, I'm going to save a few bucks, and my max loss is a lot smaller. And that's the huge advantage here, is that if we're able to sell some of these calls against that, now I have this position, this is known as a collar strategy, in order to finance the put behind it. So think of how this works and operates is if you're able to always have insurance on the position and on the stock, and constantly being able to have that protection. Now, when that stock comes crashing down, you're able to limit the downside losses. That's phenomenal. That's fantastic. And you're really not spending any money on getting those puts. But the disadvantage here, of course, is you're giving up some upside. Anyways, this is what we covered in this zero cost put buying strategy. But if you have questions about some of the other classes and courses that I've done over the years, feel free to reach out. Let me know in the comments, and I'd be happy to give you some more insight. But if you're serious about insuring your positions, especially if you've got, 6 figures, 7 figures, 8 figures or more in your trading account, if you've got money in there and you're not insuring it, it's really a little bit more dangerous because now you've got, high expensive accounts and you've got a lot of value in there. You've got a lot of money that's tying up probably for your retirement, your kids, and you're not insuring those positions. Well, now that can become very dangerous. So this is a cost-effective way of doing it to insuring your positions, your value, your nest egg, in order to do it in a cost-effective way. Anyways, thanks for joining me. Hope you've got a lot of insight on here. If you're interested in some of the classes we've got, reach out on our website, and I'd be happy to share with you some insight behind all the classes that we do every single month. Thanks again. I'll see you next time.